Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, so let's get into the Q&A episode today. And the first question is from William. And William writes, thanks for all your efforts with the podcast and blog. They've both been so valuable for me as I try to lay the foundations of my future. William then goes on to sort of lay out his financial position. He's 29, living with his parents, has 30,000 in an emergency fund, 70,000 of savings, 10,000 in an ETF portfolio, and about 65,000 of super, of which 21,500 is used for or parked for the first homeowners saving scheme. So I guess including the emergency fund, he's got about $120,000 of savings. Income is 115,000. William's partner is 25, working part-time, but may pursue further studies and don't want to rely on her income. The issue with William, I don't know if I should call it an issue, it's really an opportunity, is that he's set to receive a pretty sizable inheritance from his grandfather's estate of 750,000. And he mentions that, I talk about the power of leverage with property, buying investment grade property, buy and hopefully never sell and just enjoy the compounding capital growth over many decades, which is exactly right. It's what I talk about, and it's really the power of property. Whereas William's observation is, well, he's got a limited borrowing capacity. And so if he uses his inheritance and buys the best property he can buy, it's not going to be heavily geared, right? Because he's got limited borrowing capacity. He might have, let's call it 850,000 of cash to put into the property. And, his borrowing capacity might be, 400,000 or something. So it's only going to be geared to like 30 or 40%. And so I acknowledge that. And so he's saying, well, what do I do in that situation? And it's worth mentioning this long-term goal. In about 10 years, he would like to be able to spend about $2.5 million on a family home. So look, it's a really good question, William, because it demonstrates that you need to, I guess, have a good sense of experience to know when to or how to navigate these fundamental principles of property, which is sort of gearing and buy and hold and these sorts of things. So maybe William presents a couple of different options. Should I buy investment grade property with as little inheritance as possible? Do I put all the inheritance in there, etc.? I'm going to put that all aside for a second and just reframe the question from William to say, okay, if I was in William's position, what would I do? And my key focus here is the fact that I'd like to be in a position in 10 years' time to be able to buy into the market and spend $2.5 million. I guess the key thing I don't know is William's occupation, which will tell me a little bit about, how his income may change over the next 10 years. Because depending on occupation, income can change a lot from age 29 to age 39, of course, and that would be kind of useful to know. But let's just assume it's not going to change all that much. Then the key question is, how can William magnify hopefully double the amount of inheritance he's got? Because if he could do that, or even more than do that, maybe he can take the 850 odd thousand of wealth he's got, plus the income that he'll have over the next 10 years, and maybe turn that into hopefully maybe a couple of $1 million. So then in 10 years' time, he can go and spend 2.5 and have a relatively low mortgage of only $500,000, for instance. And that's kind of what I'm thinking about. How could I go about doing that? So the first thing that comes to mind is that quality is key here. It's about, and if I want to try and maximize returns over the next 10 years, and I'm not saying that people should necessarily come with that lens or that focus, because it's really about maximizing long-term wealth. But in William's situation, he's got a clear goal, a clear 10-year goal. And so it really is, in his situation, about maximizing the next 10 years worth of returns. What he should do is buy in a market that's about to enter into a growth cycle, has only just recently entered into a growth cycle. So certainly avoid markets that are end of a growth cycle. He should buy the highest quality property that he can buy. He should buy something that will allow him to manufacture a bit of equity and growth. So that is spend most of the money on the land and then over the next 10 years find opportunities to improve the improvements on that land. So that is buy a house that really needs a little bit of love. Maybe a new kitchen, bathroom, flooring, perhaps window furnishings, paint, these sorts of really purely cosmetic improvements that can really add significant value, but something that the dwelling has to be fundamentally sound, of course, and the floor plan's got to be it's got to be a logical, workable floor plan. Floor plans is one of those things in properties that I think is probably, in my view, one of the most common impairments that I see. A floor plan isn't logical. You've got a toilet leading off the living area, for example, or you've got bedrooms that are kind of spread all over the house rather than one particular part of the house. I think that's the most common impairment I see. So anyway, that's what I would do if I was in William's situation. So it really is swing for the fences. Harness all your financial means, which includes all your inheritance, and buy the best quality property that you can that kind of meets those criteria, because you put yourself in the best position to generate the highest returns over the next 10 years. Now, in regards to leverage, look, what you might want to explore, and you want to talk to a tax agent about this, is that maybe a better option is, instead of receiving the inheritance from your grandfather's estate, perhaps, for instance, your parents could receive that inheritance on your behalf and then lend you the 750,000, and then you could use that loan to go and buy the property. Now, the reason I suggest that, now you need to speak to a good mortgage broker about this as well, how to structure it, but the reason I suggest that is that you could then in the future refinance the debt against that property and pay back your parents, in inverted commas, if you like, to allow you to re-gear. So let me explain in hopefully a bit more simpler terms. If William's income's 115,000 today, but he expects it to be significantly higher in 10 years' time, well, one of the opportunities then in 10 years' time is he might like to keep this property that he buys and still be able to buy the $2.5 million home. But he wants to make sure the gearing is optimized in terms of the maximum tax deductible debt. So what he could do is then increase the loan against this new property, pay back his parents, because he used that borrowed monies to buy that property initially. It'll preserve the tax deductible nature of that debt. And then he can use that cash, in inverted commas, to go and buy his family home. So when we do have cash, it's always good to start thinking about, is there a way I can structure it so that I have the ability to optimize my gearing in the future? And the only answer to that, the only way you can do that, is if you are able to borrow the money initially to buy that. Now, that might be off a related party, such as parents or an entity that, a family trust, for example. There's a couple of ways to go about it, but that's something I would explore as well, so that you don't forego. You try and maximize your borrowing capacity today, that's fine. But if you expect your borrowing capacity to be significantly different in the future, then that's a way of optimizing it. And then in 10 years' time, I always say buy, never sell if possible. But in 10 years' time, I mean, it's hard to predict where anyone's going to be 10 years from today. But in 10 years' time, I guess William has a couple of options up his sleeve. He could potentially re-gear the property, as I just talked about, and retain it. But he might need to sell it just because of cash flow and borrowing capacity. But if he's held it for a 10-year period, that's typically long enough. Again, if he's applied the same fundamentals, buy a really good quality property in a market that's about to enter a growth cycle with something that I can add value to, he's positioned himself to at least maximize the outcomes of holding that property for 10 years. So it's not a terrible outcome if he has to go and sell it to be able to achieve his goal of buying for $2.5 million. But great question, William. And I think it's a great question because it helps everyone else, all the other listeners, understand that sometimes you need to be a little bit more, I guess, inventive about sort of the approaches while still sticking to those fundamental considerations I talk about in the podcast. Okay, next question is from Sarah, a bit of a long one again, so I'll just paraphrase or summarize if you like. Again, another interesting one. All these questions are really interesting, so please keep them coming. Although I've got a heap to get through, I'll need to figure out how to do that. Anyway, Sarah and her husband are in their, 33 to 34, so it's called mid-30s. $375,000 of family income, so 165 for her plus bonus, and husband 160, so relatively similar incomes. Perfectly utilising the tax brackets there, which is great. Husband has 200,000 in super, she has 150. She's currently on a 12-month maternity break, so at the moment cash flow is pretty tight, sort of neutral if you like, because they live in Sydney. They own a investment property in Newcastle, which they bought in 2017 when their incomes were much lower. 2-bed, 2-bath, 1 car. And they recognise it's not investment grade, so they feel like they should probably move on from that investment. They expect to clear about 130 to 150,000 after all costs and CGT and all those sorts of things. As I said, they live in Sydney. The home is worth 2.1 with 1.25 mil mortgage. Hence, that's why they're sort of break even whilst on maternity leave with the larger mortgage. They're happy with their home. It's on a block, pretty large for the suburb, with potential to improve, build a family home, or even subdivide down the track, which is great. They've got 120,000 redraw, so they've obviously made some extra repayments. And the question is really what to do with this money, this 130 to 150 that they might clear from the investment property. And Sarah's listed a couple of options they've been considering: pay down the home loan and borrow against the property. So pay it down and get a new investment loan invested in ETFs. Use the funds to go and buy another investment property, kind of replace it if you like, or something else. I should mention in the follow-up question, which I'll get to in a second, Sarah mentions that they've both got potential for some significant income growth. Her husband in particular, which I think is really relevant to answering her question. So what would I do if I was in her position? Well, given cash flow is relatively neutral, so they're covering living expenses. And I should also say there was some other comment about, well, they've got one child, she's on maternity leave, but they might have 1 or 2 more over the next 5 years. So it's a pretty difficult time to build wealth during the period of time where you're starting a family or building a young family. So that is, I would say, when you've got kids that aren't yet at school age, because once they're at school, expenses kind of normalise a little bit. You get rid of childcare, nappies, all those sorts of things. And then also you've got a little bit more time to re-enter the workforce and work more and earn an income. So that period of time, and if you have one child, it might be 4 or 5 years. If you have several children, it could be a decade. Is kind of difficult to navigate, depending on incomes, of course. So that's why there's a window of opportunity really before you start a family, and then the next sort of window of opportunity is when the kids get into primary school, in which case that if you haven't made any headway to building wealth, you should really get on your bike and try and do that as soon as possible and not wait until what is a common situation, maybe not as much today, where people kind of get to the end of having school-age kids and then starting to think about, maybe we should build wealth. Anyway, I need to get back to Sarah's question. I think if there's income growth in the future, I think what I would do is put the money in the home loan. And so let me explain my rationale for it. Well, money in the home loan is going to generate a saving, let's say, of 6 to 6.5%. I don't know what your interest rate is. Let's call it 6%, in fact. That's an after-tax saving, right? So to be better off, you've got to earn something higher than that pre-tax. Let's say you're going to pay an average tax rate or even a marginal tax rate of 40%. That means you've got to earn somewhere between 9 and 10% from an investment for you to be better off. And putting money into the mortgage is a risk-free return. You're always going to save 6% compounding each and every year as a result of making those extra repayments. That's guaranteed. Returns are not guaranteed. Now, that doesn't, I guess, deal with the fact that what we really want to do is have more growth assets. That if their income is going to be high, they've got $1.2 million of debt, they're relatively young, they're probably over their working life going to be able to repay that debt. That's not a problem. So therefore, the priority should be acquire more growth assets. My issue is at the moment, their borrowing capacity is impaired by the fact that Sarah's on maternity leave. So it's not a good window of opportunity to potentially go and replace that asset. Plus also, when people are just going through that family planning, whether you have 2 children or 3 children, that can make a big deal because it's another sort of 4 or 5 years kind of a difficult cash flow. I would like to at least typically give people the room to make those lifestyle decisions, which are pretty important lifestyle decisions, family decisions. So rather than put them in a situation where we've overinvested and as a result they can't have that third child, or they feel like they can't have that third child without selling an investment or doing something like that. So I think put the money in the home loan and enjoy your rising incomes. And then if you get to a point in time where you think you'll only have one more child, so two in total, or you're pretty confident then to take on an additional commitment, and hopefully between now and then you've got more equity in your home and you've got higher borrowing capacity and more income, particularly if you're between children and, Sarah, you return to work at least in some format, that'll help your borrowing capacity as well. And then, because that would be the next move, right, is to replace that investment property with an investment grade asset. Now, you're going to have to spend a bit of money to do that, probably seven figures, in the a million or more, to be able to buy something that performs really well. And you could still do that in Sydney, for example, or in Melbourne, for instance. So that would be my next move. Put it in the home loan and then find the next opportunity over the next, let's say, 3 to 4 years to buy an investment grade investment property. And you need to get those bigger assets under your belt first before you necessarily start borrowing to invest in the share market, because those bigger assets, the sooner you get into the market, the more time you've got to enjoy that compounding capital growth. And Sarah's second question was, when does financial advice become viable for people in our situation, which is PAYG employees, not business owners? We both have potential for significant income growth, my husband in particular. I'd like to know that we are structuring our assets in the best way, but understand we don't yet have the wealth to be appealing clients, a catch-22. It really is a catch-22, Sarah, and it's really difficult. I mean, I've spoken about it before on the podcast in answering other questions. My view is, our view, I should say, in our business, is that what I want to do is make sure that if I'm going to work with the client for, say, the next 10 years, when I look back over that period of time, I look back and say it's a no-brainer. Like, it's a no-brainer for the client. Because at the end of the day, and it sounds altruistic, but it's not, it's very selfish. At the end of the day, we can only deal with so many clients. And I get a lot of satisfaction from, working with clients, helping them achieve their goals, and then looking back in 10 years' time going, yeah, well, I really made a difference. And that's why I come to work. And so therefore, to be able to get that level of satisfaction, you need to pick the right clients where there's enough scope to add value, way more value than you charge in fees. So the client is then delighted and you're really happy with the results. Now, that doesn't necessarily mean I choose a 10-year time horizon because, my view is that you've really got to be able to work with clients on an ongoing basis to significantly add value. We've tried in our business, albeit maybe 10 or 15 years ago, to try and do piecemeal advice, like, give people a little bit of advice and say, look, this is what you need to do. Go and do that and come back in 5 years' time, for instance. It doesn't work. And it doesn't work because there's always nuance. And when it comes to implementing, you want to make sure the advice is implemented correctly. And what we found was that we would give people advice and do A, B, and C, and D, and they would only do a couple of those things, and then they would change, instead of buying this type of asset, they bought this type of asset, or instead of investing this way, they just changed a little bit because they thought they were doing the right thing, and then they completely messed up the implementation of the advice. And so great quality financial advice is only valuable if it's implemented correctly, of course. That makes sense. And so that didn't work because, it worked out for us from a commercial perspective, but from the client's perspective, it didn't work. So I know that you've really got to be able to work with clients on an ongoing basis to make sure we navigate inevitable changes in circumstances, markets, capacities, everything that kind of life throws at us, to make sure it's implemented correctly. So that makes it really difficult, right? Because if you come and approach me today and go, well, at the moment, there's not a lot of scope. If you say, well, how can I work with Sarah and her husband? I would say, well, what can I help you with? I can help you with this one decision about what to do with the money from the property. But then beyond that, over the next couple of years, you might not have a lot of surplus cash flow. You've got relatively low super balances. So, as long as they're at a good industry fund, low cost, invested in the right way, there's not much else I can do. And so what's the point of you paying me ongoing fees if I'm not doing any work? So what's the answer to your question? Well, I think you've got to be closer to making some pretty significant financial decisions. So as I said, maybe your next goal is after you sell this property is to replace it with another investment grade asset. If you get a great mortgage broker and a great accountant and a great buyer's agent, you can probably execute that yourself without necessarily any advice. Now, you need all those three advisors to be great at what they do, but all those advisors offer transactional advice rather than ongoing advice. And then I think probably once you get to a point where your incomes are higher and you start to have a lot of investable surplus cash flow, that's probably the point in time to start talking to an advisor and coming up with a longer term strategy. I appreciate it doesn't really help you very much, and it's a bit of a long-winded answer, but hopefully it helps you, Sarah, and people in very similar situations to kind of understand the approach that certainly we take, and I think is the right approach. I'm taking my financial planning hat off, of course, which I always do in this podcast, try and put myself in your shoes. I think that is the kind of right approach when dealing with financial advice. Okay, the next question is from John. Not really a question, but merely a sort of offer of help to some degree. Anyway, John provides some great feedback on the podcast and really references to the podcast that I've done recently on internal rates of return. And just to remind people, internal rates of return expresses a percentage return on the cash flow that you've contributed towards an investment, like an investment property, because obviously we borrow the full cost. We don't put any cash in at the beginning, but our cash contribution comes when we have to pay for the holding costs of that property on an after-tax basis. And then one day we'll sell the property and end up with a bunch of cash in our pocket after paying all tax and repaying the loan. And so it's really comparing, how much cash have we put in to the property each year over the period we've owned it, compared to, how much money do we have in the bank when we walk away after selling it, and expresses an annual rate of return. That's internal rate of return. And I've spoken about that a couple of times. And then, of course, you've then got to think about, as well as allocating a scarce resource. So you've got a finite amount of borrowing capacity, everyone does, and you want to allocate that borrowing capacity fully, if that's safe to do, in the opportunities that deliver the highest internal rate of return. And at the end of the day, the main goal, the key goal, that this is the absolute thing you need to focus on, is the amount of wealth you're ultimately going to build in dollar terms, because that's how we're going to pay for retirement. If one strategy is only going to put $500,000 in our pocket in 20 years' time versus another strategy is going to put $2 million, well, you don't have to be Einstein to work out which strategy is going to be better. Anyway, John wanted to share a free resource that he has developed, a way of measuring the internal rate of return of different property investments. I haven't looked at his model. I haven't studied it. I'm not going to tell you it's great. I'm not going to tell you it's bad either, because I haven't looked at it, nor am I saying that it's going to be accurate. Of course, we have our own models internally. But if anyone wants to check it out, you can go to financialactuality.com/property evaluation. In fact, if you just go to financialactuality.com, I'm sure there's a link that takes you to the internal rate of return calculation, and you can download the model there and have a look at it. So for anyone that likes to kind of nerd out in the numbers, have a go at doing that. And thank you so much, John, for, sharing this free resource. John mentions he's got no vested interest, in terms of whether people use it. He's got nothing to sell. It's just a resource he'd like to share with the community. So thanks very much, John, for doing that. Okay, next question is from Ron. Ron writes, thank you very much for your efforts in educating the general public. Financial literacy is essential, and I strongly believe it should be taught to every student, ideally in year 11 and 12, to help them better understand personal finance throughout their working and retired life. Since it's not currently part of the curriculum, your work in this space is truly valuable, and I appreciate it. Thanks, Ron. My sons are 18 now. I try and talk to them about finance. They roll their eyes and just make fun of their dad. I'm not picking on them. I'm sure everyone that has sons that age has a similar experience, but I just find it ironic that you make that mention, and I'm trying to, eventually I'll get through them, I'm sure. Anyway, Ron writes, I have a question regarding ETFs. My wife and I are both 43 years old. We hold a property in our self-managed super fund. The property's value is $615,000 with an outstanding loan of $380,000 and an interest rate of 7.1%. We currently have $165,000 in an offset account against this loan, and we expect the balance to increase by approximately $30,000 or $40,000 a year after our contributions and covering all costs. After listening to episode 342, I realised that our self-managed super fund lender is not an ADI, an approved deposit institution, that is, which has led me to reconsider our strategy. Just to let you know, in that episode, I spoke about, there's some lenders out there that aren't ADIs. If they're not ADIs, they don't benefit from the government deposit guarantee, which the government guarantees, deposits up to $250,000. So if the bank goes bust, the government will pick up the bill or indemnify you against any potential loss there. And so if you've got a lot of cash, you want to make sure it's with the ADI, I think. Anyway, Ron continues to write, I'm now contemplating investing the offset balance in equities. Could you recommend some ETFs that focus on capital growth? Additionally, given that the market is at an all-time high, would you suggest investing gradually over time and then making a lump sum investment? Appreciate the insights and look forward to general information on this matter. So, Ron, great question. The key to answering your question is you said you're 43 years old, so you can't access super until 60, 17 years. I would say that your focus should not be on repaying the loan. Hopefully, if the investment property performs, the loan will be immaterial by the time you get to age 60. So that should not be your focus. Your focus should be acquiring more growth assets. So even if you were with an ADI, I would probably still say you should probably invest most of that cash. Now, it's a property, so you want to have a bit of flexibility and a bit of buffer. So you have 165,000 increasing by 30 or 40,000 a year. Of course, you wouldn't go and take 165,000 and dump it in the market. You'd want to maintain a bit of a buffer. So I reckon keep 30 or 40 grand in cash in the offset account at all times, just in case there's some expenses with the investment property that you need to deal with. Now, for the rest of the monies, how do you invest it? One of the problems with using ETFs, well, you could use a diversified ETF, of course, like DHHF, which is with beta shares, and that would work perfectly well. If you wanted to have more of a holistic investment strategy and you have a self-managed super fund, one other option is to establish an account with Host Plus. So Host Plus let you establish accounts in self-managed super fund names, and then you could invest it in their high growth investment option, if you like, which is going to then be managed. It'll give you different exposure, different type of assets. There's pros and cons with that. I've always sort of argued that the opaqueness with the investment management in the industry super fund space is a concern. So I'm not saying that's a better option, but it is an option for people that just want a really easy way of kind of managing money. But I think a diversified ETF in your situation would work really nice. So DHHF, Vanguard also just released a new all growth, because it's all shares, that diversified ETF, all growth ETF. And its ticker code is VDAL. VDAL. Brand new, 100% invested in shares from Vanguard. So one of those two products I think would work really nice. Ron's additional question is, what do I do? Do I invest in a lump sum? No, markets all-time highs. Look, they could continue on their merry way to generate better returns. The market can run harder and longer than anyone might otherwise anticipate. But I think I'd drip feed that money in. So look, I think I'd invest maybe, say, $10,000 a month, for instance, just sort of off the top of my head. Keep doing that until the balance got down to, as I said, $30,000 or $40,000, and then probably back it down to sort of maybe $10,000 every 3 months, for instance. That's investing $40,000 a year. Therefore, so you're gradually sort of entering the market in that way and spreading your timing risk. Anyway, great question, Ron. I hope that helps. Not advice, information, of course, but that's what I'd be thinking about if I was in your shoes. Okay, next question is from someone called Meteor Girl. Anyway, just to paraphrase her question, she's trying to choose between two options. She's got the opportunity to buy a 10% share of a business, I guess the business that she currently works in, and the business makes about 10% profit. So obviously that's her return, is a 10% return, versus just buying investment property, for instance. Look, buying into a business and buying a minority share into an unlisted business does come with some risks and opportunities, of course. What is the value of a 10% share of an unlisted business? Well, the value is zero, right? Because you can't sell it. You can't sell it to someone else. Not only will the shareholders agreement probably restrict you from doing that, but who wants to buy 10% of an unlisted business? Who wants to put their money in an investment where they've got no control, no transparency? It's a small business, unlisted, no liquidity, etc. So, this is the thing. When people put money into a business and they're going to have a minority share, they've got to realize if there's a falling out and they need to go and get, well, what is the market value of the true market value of a minority shareholding unlisted business is zero. Now, what is the fair market value? Well, of course, there is some value there fundamentally if it's generating profit, but that's, one of the issues. The other issue is like, okay, if it's making 10%, that's great, but how much of that profit will be paid out versus reinvested in the business? And how much should be paid out versus reinvested in the business? So whilst it's generated 10% profit, you might not actually see that cash, and it might, in fact, be better off to reinvest it in that business. And the last thing to really then think about is what is the exit strategy? How and when will you get your money back? And what does that look like in terms of, is it a valuation, a multiple of profit? Is it a valuation you have to go out and pay for at the particular time? And what is the trigger event? Is it you leaving that employment? Can you request to sell those shares back to the owner in the future? They're all the things that you really need to think about when contemplating that investment. Now, there could be additional benefits associated with having a shareholding in your employer. So in terms of giving you some security, potential job security, ability to add value to the business beyond what you're getting paid for in your salary and benefit from those outcomes. There's other benefits there. And of course, if it is in fact going to increase your income, well, it increases your borrowing capacity. And if you have equity in other property, that'll help you invest as well. So there's some of the things to really think about versus buying investment property. You'd really want to understand, how long you're going to expect to work in that business for. What is the exit strategy? What does the income look like that's coming off that investment? Do you have other ways to build wealth? Other than, can you do the investment in the business and then down the track go and buy an investment property? They're the sorts of things I'd be thinking about, but such a broad question, and every situation is so different in this regard. It's difficult to, share some, not specific advice, of course, because I don't share advice in the podcast, but more specific guidance than that. Okay, and because I've got so many questions to get through, I'm going to squeeze in one more, and I hope people don't mind me going over. Typically, I like to keep to half an hour. Anyway, the next one is from Kaza. Kazas writes, I love your book and podcast and blog, so thank you very much. Thank you for the excellent quality information, your ability to break down complex concepts. My question relates to being equity rich, cash flow poor, and your thoughts on how to transition to a perpetual portfolio, which you've discussed in your podcasts. My husband and I are long-term property investors, also have ETF holdings along with super. The problem is that while the investment properties has delivered us significant capital growth over the past 15, 20 years, they've also have ever increasing maintenance issues and compliance costs. Recently, land tax has also increased significantly. While the properties are slightly positively geared overall, they will never generate a lot of income. Can you please outline a framework and key considerations to move the investments from property heavy to a more cash flow friendly situation with a view to delivering around $180,000 of income to live off? What would such a portfolio look like, noting that we like simplicity of ETFs? And Kaz has actually provided me details of all the properties, so 5 investment properties ranging in value. Well, most are 4 are close to or over $1 million each. One at 650,000. I can't add up the total debt, but the total debt's 1.2, but the value is significantly more than that. The home has no debt against it. Anyway, I don't think we need to get into the detail too much with respect to this one. But then how do you transition from, that position where you've got a lot of wealth in property into a situation where you've got a perpetual portfolio that's going to give you a really great lifestyle. I should mention they're 57 years old, so getting close to that 60, being able to access super. They've got about 1.3 million in super. So they've done incredibly well, Kazza, in terms of building wealth. So congratulations on that. I should mention, actually, yesterday I was having the conversation with the team at work because they were querying our financial model that, in fact, for investment grade property, it really doesn't generate a lot of cash flow after a long period of time. And the experience is very similar. And the reason for that is the experience is very similar to Kazza. And firstly, we like to be conservative with our financial projections. But if you invest in high growth property, property that is mostly land value, you will experience, and you hold it for 15, 20 years like Kazza has, whilst you've got some great outcomes in terms of wealth building, which is exactly what you need it to do, it starts to become quite expensive to manage. There's more maintenance issues. Land tax starts to become, really creeps up on you, and it can change significantly from one year to the next. So you can't necessarily build a property portfolio and tick both boxes, which is get great growth, but also have a portfolio that's going to generate a lot of income. And that means people need to think, hopefully, in fact, before you're 57, start thinking about what is the strategy look like? What does the strategy look like to transition a portfolio? And I think someone in Kaz's position would definitely benefit from ongoing financial advice. That is, in fact, let me just roughly add it up. There's over $5 million of property there with $1.2 million of debt. Essentially, what Kazza needs to do is gradually divest of some of these properties, try and get as much money into super as possible to benefit from the total transfer balance cap, it's called, which is the total amount you can have in super, which is $2 million per person from 1 July this year. So Kazza can potentially get another 2.7 million in super and not pay any tax on the investment earnings. That makes a lot of sense. But it's going to take a bit of time to get that money in because of the contribution caps, and you want to be, really strategic around it. And then you want to be strategic around which properties to sell first, which ones to keep. You'll want to keep probably some, maybe there's 5, probably sell a couple, keep 3 maybe, or sell 3, keep 2, something like that. It would be my guess. Probably need to do that over the next 10 years. So it's not something you're going to do tomorrow. And you'd have to model it out and see how it's going to work. Kaz has asked about, well, what about ETFs? Well, when you've got a portfolio size, we've got 1.3 million in super. Let's say we sell a couple of properties and another $2 million. You've got $3 million of money to manage there. I would say there's great benefit in having a financial planner do that for you, a good financial planner do that for you, because it's just too much money to manage on your own if you don't have the skill and experience to do that. And ultimately, you want to have a portfolio that's going to give you $180,000 a year, probably so you can do a bit of travel and live life. And you certainly don't want to be worrying about money or dealing with investment decisions and all those sorts of things. But, it's a great point in terms of, and I did a podcast on it last year in terms of property cash flow. How long does it take for a property to start paying for itself? And it's a lot longer these days because of higher holding costs and land tax and these sorts of things. And it really then does necessitate a bit of planning around that sort of transition from being very property heavy into retirement, so you can build yourself a perpetual portfolio, which means that you can spend $180,000 a year and not have to eat into your capital. Okay, it's a bit of a longer episode today, so I apologize for that, but I might just leave it there. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.